Listen to me. If you are retired right now, or you are sitting there getting ready to hand in your resignation letter, and you think holding on to that residential rental property is going to be your ticket to an easy, stress-free monthly paycheck, I need you to stop what you are doing, sit down, and listen to every single word I am about to tell you. People come to me all the time and say, "Susie, I bought a rental property 10 years ago. It pays me $2,000 a month in cash flow. That is going to fund my retirement." And do you know what I tell them? I say, "Can you really afford that rental property, or is Uncle Sam going to take a giant bite out of your retirement dream?" Because here is the truth that nobody wants to tell you. Rental income in retirement is not passive magic money. It is taxable ordinary income, and if you do not handle it correctly, it can trigger a domino effect of tax traps that will destroy your hard-earned retirement savings, inflate your Medicare premiums, and drain your bank account. Let's talk about the big fear first. The fear that you worked 30 or 40 years to build a nest egg, only to lose control of your taxes the second you stop working. You think that because you are retired, your tax rate automatically drops into the basement. Wrong. If you have a pension, Social Security, 401k, or traditional IRA withdrawals, and thousands of dollars in net rental income coming in every single month, guess what? You might land in a higher tax bracket in retirement than you were in when you were working full-time. How does that happen? Because net rental income, that is your rental revenue minus allowable expenses like mortgage interest, property taxes, insurance, and maintenance, is added directly to your adjusted gross income. The IRS treats it just like ordinary income. It sits right on top of your taxable Social Security and your required distributions. And it gets worse. Have you heard of IRMAA? That stands for the Income-Related Monthly Adjustment Amount. If your rental income pushes your modified adjusted gross income over certain strict federal thresholds, Medicare hits you with a massive surcharge on your Part B and Part D premiums. And here is the kicker, Medicare looks back 2 years. So the rental income you collect today can force you to pay hundreds of dollars more per month for your health insurance 2 years down the road. You think you made an extra $5,000 in rent, but after income taxes, higher Medicare premiums, and local property taxes, you end up with pennies on the dollar. And what about when you decide you are tired of being a landlord at age 72? You don't want to fix broken toilets or chase down late rent payments anymore, so you decide to sell the property. You think, great. I'll take my $500,000 profit and enjoy my golden years. Stop right there. Have you accounted for depreciation recapture? Every year you own that rental, you are allowed to claim a depreciation deduction to write off the structure. But the moment you sell that property for a profit, the IRS comes back to recapture that depreciation. They will tax that accumulated depreciation portion at ordinary income rates up to a maximum of 25%, plus you will owe long-term capital gains tax on the rest of the profit, plus you might owe the 3.8% net investment income tax if your income exceeds $200,000 for single filers or $250,000 for married couples. Suddenly, a third or more of your sale proceeds vanish in one single tax year. That is not financial freedom, that is a tax nightmare. So what is the question you need to be asking yourself right now? The question is not how much rent can I collect? The question is what is my net, after-tax, risk-adjusted return on this rental property compared to other retirement income streams? Here are your actionable takeaways. Here is what I want you to do right now to protect your money. Number 1, keep flawless accounting of every single deductible expense. Mortgage interest, insurance, repairs, property management fees, travel expenses to inspect the property, HOA dues, every legitimate dollar you spend reduces your net taxable rental income. If you don't track it, you are voluntarily handing your money over to the IRS. Number 2, look at your total income picture before taking large withdrawals. If your rental income is pushing you close to a higher tax bracket or an IRMAA Medicare threshold, do not pull extra money out of your traditional IRA in the same year. Coordinate your withdrawals so you stay below those financial cliffs. Number 3, if you want to sell the rental property in retirement, do not just sell it for cash without a plan. Look into a 1031 exchange if you want to roll that equity into a passive real estate structure like a Delaware statutory trust, which allows you to defer capital gains and depreciation recapture taxes while stripping away the burden of active landlording. Or, if you don't need the liquid cash today, consider holding the property until it becomes part of your estate so your heirs receive a step up in cost basis upon your passing, wiping out that built-up capital gain tax entirely. Listen to me, sample your numbers, talk to a qualified CPA who specializes in real estate taxation, and never make a move out of panic or assumption. You worked far too hard for your money to let preventable taxes steal your peace of mind in retirement. Stand tall, get control of your finances, and protect what is yours.